Rate cuts, inflation, market shifts. Here's what you need to know about the Vancouver real estate market for March 2025. I'm Christine Kopr, and every month I try to walk you through what's happening through our Greater Vancouver Realtors stats, as well as other market influencers that are going to shape how Vancouver's market is operating today and going to shape out in the future. And this month, we're actually also at the very end of this video, make sure you check it out, chat a little bit about the carbon tax and our new Prime Minister's policy of carbon on industry, and really highly encourage everybody to take a moment to watch the video of our local developers and one of our mayors discuss what's happening in housing, what's that outlook, because we've all been hearing it. Condos are suffering, and that's really impacting any new supply, which could potentially turn into our next housing crisis. Let's take a look at the stats and get right to it. Okay, every month I go through these monthly stats and put them into perspective with you, touching on the key numbers that we need to put into perspective. We are now talking about the end of February as we're reporting in the month of March, because now we have all of February's data. So sales in February for Metro Vancouver, or the Greater Vancouver Realtors Board, which covers Whistler all the way to Maple Ridge, we had 1,827 sales in February. That was up 18% month over month, but it was down 12% year over year and down 29% over the 10-year average. We were seeing a bit of an increase in sales. You're going to see that here at the tail end of the year, coming out of August into September, October, November, December here for 2024. And we started to see numbers, our sales have been weak. But they were starting to recover. They were down at that 25% below the 10-year average, climbing up into around that 15% around the 10-year average. And January was even looking better. However, if January was not that great, and then February also tapered off here down into this almost 30% below the 10-year average. So definitely the demand today in the market is weakened. And that's not surprising given what has transpired in the last month or so with the talk of the trade war, tariffs impacting our future economy and prospects, and people concerned about their jobs and the future of Canada. Now, going over to listings, we had 5,700 new listings come on the market in February. That was down 9% month over month, but up 11% year over year, and about 12% above the 12-year average. There was a lot of cries out there with a lot of inventory coming on in early January. That was a big number. It was definitely one of the highest months we've ever had in new listings in January. Last month, if you listened to my video, wasn't sure if that was some of the typical spring market inventory getting pulled forward, just getting ahead of the game and showing up in January, or if we were going to be expecting even more new listings coming on in the springtime. And that's something we're keeping our eye out on, because we're not quite there yet. The weather hasn't been cooperating. It's been raining and it was snowing a lot in February. So that also put a damper on sales. And I was wondering where things were going to go, but also for new listings, if people were going to hold off into the spring here. But we've tapered off a little bit from January, which is a good sign. And that leads us over into our inventory. Now, this big panic about the amount of listings that have come onto the market. Yes, we definitely had a very standout amount of listings coming on. We're above the 10-year average, but this one's not so bad. But here, this was pretty high for January. I think it was like north of 30% over the 10-year average. So it was a bit of a call out there. However, new listings are irrelevant unless you put it into context with the amount of sales or the demand going on in the market environment, in addition to the total amount of inventory available. And interestingly, at the end of February, we were sitting at 12,744 listings. That's 11% up month over month, up to 32% year over year, and up 36% over the 10-year average. So yes, we are in an elevated listings territory. However, if you take a look at 2024, you can see that we're still slightly below where we were in the fall, when we actually started to have a bit of a tightening up in the marketplace, and we start to see a little bit more of hope for this spring market. What would be concerning if we start to see this uptick into the 14,000, 15,000 range for inventory, and the sales truly falling off and staying very well below, then we will continue to see an accumulation of inventory. And that's starting to show up for sure in our months of inventory. This is one of my favorite metrics for determining which way our price is headed. And you can see that we're sitting at 7 months of inventory, with 4 months and below being a buyer's market and 6 months and above being a buyer's market. So 4 months and below is a seller's market. There is more demand than there is inventory, and you would sell out through all your inventory in 4 months. 7 months of inventory, there is more inventory than there is demand, and all that accumulation of inventory starts to put downward pressure on prices. But you can see that we actually tightened up in terms of months of inventory here between January to February. We're down from 7.4 months of inventory to 7 months of inventory, so down 5%, but we are substantially up year over year, almost 50% in terms of months of inventory. So yes, we are definitely in an environment where there is going to be downward pressure on prices depending on your market segment. But generally speaking, yes, there is downward pressure on prices from a macro perspective. And you can see that here in our benchmark price. Benchmark price is down month over month, just 0.3%. So it's basically flat, but it's also down 1% year over year, which is a very interesting thing when we think about where we have been in the last couple of years with extremely high elevated interest rates, that our overall benchmark price has actually hung out pretty well. I would have thought by now that the high interest rate levels would have impacted prices more than they have. Granted, we still have, 2025 and 2026 are some of the biggest years for mortgage renewals. However, interest rates are substantially lower than where they were at the peak of this rate hiking cycle. But I wanted to put this into perspective because in terms of benchmark price, months of inventory, we're sitting at about 13,000 listings right now and sales. And if we go back into 2024, you can see, we were hovering at almost 15,000 listings here in September. The market, pretty much weakened up here. Typically, the sales were very weak for this time of year. We had our second wave of new listings for that second selling season of the year, and inventory increased, but it's a bit of a laggard because the sales start to step up in October, November, December, and then you could see that tightening up of months of inventory because we hit 8 months of inventory back in September of last year. It was not a very good time, and then things actually tightened up in the fall. So therefore, we were all very excited about the spring market because interest rates were coming down and we start to see renewed activity, which has now started to temper with the incoming administration and the situation developing in Canada. You could also see here our benchmark price, hitting about 1.2 last year, and then we're coming off 1.17, so off about 30K. But, have we been here before? And yes, we have. So this is my old graph from 2019, not as pretty as it is today, but you can see, we hit these levels in 2019. And 2019, we came out of a time with the introduction of the mortgage stress test, and that really impacted the market. Sales really slowed down, inventory grew, months of inventory grew, putting downward pressure on prices. All the prices here in red are downward pressure on price. And then once activity started to pick up in relation to the demand, we tightened up our months of inventory and prices started to balance out and then regain over time. I've been thinking about how this could play out. Now, what's going to happen with the tariffs and how it's going to impact our economy at the end of the day is to be determined. Chances are this going to very much hurt our Canadian economy. And hopefully, as the Canadian people will get out there and vote and make sure that we elect a leadership that's really taking action to correct the situation and didn't put us there in the first place and now trying to reverse ship. So those are some of the things that we can do as people, but what can we do moving forward? You really have to take a look at your personal situation and monitor, what exactly is going to transpire here. If we take a look at annual sales in 2019 and 2018 being some of the worst years that we've had, because even with some of these very elevated interest rates, we've hung in around this 26,000 range of annual sales. And, perhaps we'll land in this lower part of the range in terms of sales. So, in terms of a continuation of a bit of a softening, then perhaps this is where we may arrive. I have no idea how this might play out, but I just wanted to put things into perspective because it sounds like doom and gloom right now and everything's falling off a cliff, etc. But currently, we're still in a decent place. We're not in a hot market. No, it's a soft market, but things aren't necessarily falling off a cliff at this point in time. That could change depending on what happens in the economy. But it's interesting because I'm going to get into some granular details with the different market segments and how they're behaving since the fall, which was a very positive time. So let's take a look at that because that might give us some more insight about the confidence that our market is actually feeling. Okay, so let's get more granular and see what has transpired since the fall when we start to see that uptick in sales activity and we start to see a little bit of a tightening up and normalizing in our marketplace. So if you have a look at Vancouver Westside Detached, we're sitting at a 6% sales to actives ratio. Now, sales to actives is more granular than that months of inventory, and 12% and below is considered a buyer's market. 20% and above is considered a seller's market. So the West Side Detached segment is definitely sitting in a buyer's market, sitting at 6%, flat from February, and also not getting worse since December. It's going down from 10% ratio down to 6% ratio. So definitely we're sitting in a buyer's market in the West Side Detached market. Vancouver West Side condos and townhomes are sitting at 16%. So they're sitting in a balanced market on the higher side, closer to that 20%, which is, indicative of a seller's market. It's bounced up from a 13% in February. So notice that difference here. And coming back very close to what we saw at the end of last year in December, where we're sitting at 17%. Again, if you recall, at the end of last year, we start to see some better numbers. By no means is this a seller's market, but we've kind of had this dip in the early year. And now we're starting to see a little bit of a recovery there. Downtown condos and townhomes, 11% sales to actives ratio, flat from February, and down just a bit from the 13% in December in that balanced market, just dropping into that buyer's market. But you can see not too shabby, right? Not a big change. But look at Vancouver East Side Detached. We are sitting at 11% in March, so sitting right inside of a balanced market, up from 7% sales to active ratio, which was a buyer's market in February. And if you look back to December, we were getting into more improved market conditions, sitting at about 13% or at the bottom end of a balanced market, just on the cusp of a buyer's market. But definitely we've improved over February when we were in a buyer's market. So that's what I wanted to touch on, is that while we have been hearing negative news, and yes, it's not a strong market, there's actually been a strengthening in the Vancouver Eastside Detached market from a sales to listings ratio. And the Vancouver Eastside condos and townhomes are sitting at 21% at the end of February, in a seller's market territory. That's improved from 19% in February and coming back closer to what we were seeing in December, which was in seller's market territory. So we bounced down into a upper end of the balanced market, and back in December was in a seller's market. So you can see that it really depends. The sales to actives ratio, which is a good indicator, are we where we're at in terms of the market today and what might transpire if we stay in these ranges over the next couple of months. And the spring market, I argue, is just getting started. We haven't had any good weather. It's been raining. So we'll see what happens when the sun finally comes out and see what the buyers have to think, given we've had interest rate reductions, even though we do have this market uncertainty. So speaking of the interest rate improvements, we just had a Bank of Canada announcement reducing interest rates again by another quarter point down to 2.75. So this is the 7th consecutive decrease in the Bank of Canada interest rate. You can see that here. This is where we were, and we're coming back down. So this is where we were prior to the pandemic, and we're getting a lot closer to that level, which is improving affordability and making it more appealing for buyers to get in the market. They just have to have the confidence in their jobs and their economic future as we move forward. But this is actually really great news. And I think these interest rate decreases last year was what started to spur that activity we saw in the late fall. We started to finally get into these more affordable ranges, with your 5-year fix and your variable rates being very close together at the lower 4% range, around 4.25% plus or minus. In some cases, we have heard of 3.89% fixed rates for insured mortgages, so less than 20% down. And with the most recent decrease, we'll probably see, that's going to impact your variable rate mortgages or lines of credit. That's not going to improve or make any impact on your fixed rate mortgages. However, the bond market has also been decreasing. And as the bond market goes down, this does impact the pricing for those 5-year fixed term mortgages. So we've seen this flattening around here, and that's why we're seeing this decrease in these 5-year fixed rates. Now, With today's news, however, with the inflation being reported, we did have a jump of inflation. It was either 2.6 or 2.7%, which was a significant jump, more than Bank of Canada was expecting. We are coming off the GST holiday, and so that makes some sense. However, we are seeing that in the areas where the Bank of Canada measures for core inflation, we have seen an uptick 2 months in a row. And with the tariffs being extremely inflationary, this could have potentially been the last interest rate drop that we are going to see for a while, because we do have concerns of incoming inflation, importing it through our goods because of our weak Canadian dollar in comparison to the US dollar. But of course, with the tariffs, for all the goods that we purchase are going to be more expensive. So these are some of the risks, the future risks that we have to be cognizant of. So if you have a mortgage coming up for renewal, this could be the time to actually potentially consider renewing early if you want to secure rates today, because we don't know what's going to happen next. We were thinking even just a week ago that inflation was hovering around here, and perhaps we were going to see interest rates decreasing further because of our economic uncertainty. And that may actually have to happen. We may need to drop the interest rates to stimulate the economy. Bank of Canada is stuck between a rock and a hard place, because we need to stimulate the economy, but on the same token, we need to manage inflation. So what happens from here is to be determined. This is going to be a day-by-day playbook. This is the time to start acting on any of those future mortgage renewals, or if you're thinking about getting in the market, securing those rate holds now, so you have the next 90 to 120 days to secure that rate in case rates do come up. And also be mindful of any rate specials, because they do show up and there's all of a sudden these great rates that only last for so long, and your broker can help you secure those rates. In other news, one of the major things that is happening in our economy because of the sales slowdown, because of the cost of construction, I wanted to touch on this slide because you can see how many units are under construction. There are strata condos that are under construction that are completing and coming to market, but there's also a lot of rental properties that are under construction. And part of that is what's been flattening out the decreased rental rates that we're starting to see. One bedroom unfurnished rents here have come off quite a bit in the last year or so. And that is great for renters, not super great for landlords, but it is great for more affordability. And part of that is the supply. We have a lot of supply of market rentals coming on, as well as in construction. So a lot of condo projects have actually turned in from a strata style of project where someone can actually own this product, and has actually converted into rental product because our government actually put in policies which made financial sense and made this product more appealing and economically viable. There was a shift to that, and so developers went to that route, and they've created a lot more rental housing, albeit it's brand new, so it's a lot more expensive, but they have created more rental housing, and there's a lot more of that coming. But what has happened in that case is we don't have a lot of new condo projects being started. And in fact, there's many issues with the condo projects that exist today. And that is an issue. It's such an issue that BCFSA has now, for condo projects with 100 units or more, they've extended the ability for developers to sell and secure the amount of homes that they need to sell in order to secure their bank financing. And they're extending that time period from 12 months to 18 months because this marketplace is suffering. So that's just one sign to give you an idea of how poorly the pre-sale market is doing, which is kind of an indicator of the future. So right now we may have this oversupply, or what could be felt like an oversupply of inventory. And we're probably going to have higher inventory over the next couple of years as these mortgages renew, because the mom and pop investors who are renewing into these higher interest rates with lower rents, it just doesn't make financial sense for them to hang on to these properties anymore. And those are mostly condo investors. You're going to see those properties coming on the market, which we have. And then you have the Airbnb rule portion, that small portion, also coming onto the market, not making really sense anymore, too much risks there. The rules now being very clear, David Evy's policies there with the new provincial registry and the fees, and then each city's registry and their fees, and so on and so forth. So we have a lot of condo inventory coming on. The main thing is the economics. I know our housing minister feels like he's made some improvements by his Airbnb changes and so on and so forth, but truly it really comes down to economics. Rising interest rates make it expensive, extremely large increases in insurance for landlords. And then, of course, decreasing rents and then rising costs of construction. So your repairs and maintenance, all your costs have bloated and your revenues have decreased. And at a certain point in time, you're subsidizing people's housing. And as an individual or private investor, they're not really there to do the social charity work, right? We're not the government. And so therefore people let go of those assets and bring them to the market. So we have that inventory coming online, and it has been coming online. There might be some folks in there that just can't afford it anymore, but I think mainly you just see a lot more investor product coming on the market. And then of course you have all this new rental supply that's been under construction that's coming on the market. And then the condos that were pre-sold 5 years ago that are now completing, those are also coming online and adding that inventory. So you just see a lot more inventory coming on in that particular segment and putting some downward pressure on that segment, I think, here for the next little while. So we do have some actors in our landscape trying to change that now that they see that one of the problems that we have is that we don't have any future construction coming or future housing supply, which is a major issue, because right now that might not be an issue, but 5 years from now, because all these projects take so much time to bring to the marketplace, it is an issue. So we're starting to see things like this, and I think this is a great idea. So Bob Rennie is in conversations with our new prime minister on bringing in foreign capital to help create more rentals, because up to now it was individual mom and pop investors that speculated or purchased pre-sale condos and then brought them to the market as rentals. And that's just not happening anymore because the pre-sale market is dead. There's such a cost difference between pre-sale property and resale property, and the outlook and the government rules and the economics just don't work anymore. So no one's really interested in purchasing those condos that truly turned out to be rentals for our market. And so Bob Rennie is trying to get a rental program together where we can leverage this foreign capital, because this money is seeking a home. You have to put it into a 25-year pool where you're going to get a preferred interest rate from CMHC. So it actually makes economic viable sense to invest into these properties. And then you must hold on to it for 25 years and you must rent it out. I mean, these are the types of policies we've been thinking about forever. It's like, why would we ban foreign investors and foreigners from investing into housing here to create that housing? I understand that some people feel that that's inflationary, but you do need someone to put up the capital and actually build these things. And if it's not you and me, then it's the government, and that's you and me through our tax dollars. So, even if we say that the government should be the ones to bring this product to market, it's actually your tax dollars that are coming to market. So you're going to pay for it, whether it's through your tax dollars or you're going to pay through it through the market and just being active in the market yourself. These are some policies that are being discussed right now because the government can see the writing on the wall that there's just not enough demand to get this housing off the ground. And even David Eby, who has been completely against any kind of private capitalism or landlords, recently spoke at a Victoria Real Estate Association and recognized that investors who buy and sell real estate actually are useful to the economy and the housing sector, right? Because he has been at war with people who speculate, or the other word is actually called invest, into creating new housing and becoming rental housing providers. And that's how we have more rental housing and housing provided to our people. They've been punishing, whether it's been speculation tax or this tax or, landlord rules or whatever, they've been punishing the investors. So they've now chased that capital away. And so now they're trying to figure out, how do they harness this investment energy at a time when they really need to facilitate creating more housing for people? So that's an interesting shift to note coming from our provincial current government. And, of course, they recognize that people aren't going to put up their money and help create this housing if they don't actually get a return on capital. So you can see that there are some changes that are in the works. They've even talked about trying to help small scale landlords who invest in multiple homes and rent them out. They're starting to see that hesitancy because of the landlord tenancy laws, and they're now going to try to do something down here. They don't have the details, but they're trying to look at how they can support people to want to be landlords, because under the current circumstances, it's unfavorable. So there is starting to be a change of tune out there in terms of supporting the investor environment to help provide that housing. Of course, as we have more supply, there will probably be some downward pressure on pricing. I don't think we're ever going to get to that $300,000 to $400,000 range for housing that is truly needed with average incomes that you can get in other provinces. Like in Alberta, I have a 3 bedroom, 1 bathroom townhouse, 1,400 square feet. That's probably worth $130,000. So it does exist. It just exists in places that maybe aren't where people want to live, but it does exist. That's what's happening with changes in terms of the housing market and policies coming forward. And lastly, the tariffs, they're a big thing. There's a reason why they're happening. I think that there was a recent article that really gave some excellent insight in the Financial Times about what's, one of our market influencers being the tariffs. And that's, besides the economics of housing and interest rates, there's also the tariffs in our Canadian economy. And it was interesting to learn that what's happening is that the government realizes, the US government, that they have to rebuild their country. And they're willing to do whatever it takes and face the economic shock that comes along with it. And so what they need to do is they have massive deficit spending, and they need to cut that spending and create revenue generating measures. So one of the things they can do to reduce the spending is reducing their government size, as well as other types of programs that they've been involved in, and then increasing competitiveness and their revenue. And so that looks like creating tax breaks for businesses to be an attractive place to attract capital and business, to implement policies that are incentivizing for their domestic industries to create more revenues. And then finally, of course, creating more revenues through tariffs, all the while trying to make their domestic industry be more appetizing. And perhaps if this was communicated in a better way, then people would understand exactly what's going on here, even though it goes against some of the major trade agreements that we already have established. It looks like this particular administration at this point in time is hell-bent on saving their country in their way. We shall see how this all turns out, because it will be inflationary for both the Americans and the Canadians. And hopefully this is something that influences and encourages our country and our leaders to start seeking other trading partners so that we can continue to develop our economy and not be so susceptible to changes by our major trading partner. Okay, and so while the US government is now enacting policies to try to make business more attractive and easier for their industry, aka reducing taxes, so less expenses for those businesses to be profitable and successful. They're also going out there and imposing tariffs on their international competition, thus to make their own domestic products more feasible and economically viable to their people, and to encourage their citizens to purchase that product, because the international imports, aka imports from Canada, are more expensive, and bolstering their tax revenues through a succeeding industry. That's the state, based on that article, that's the stated goal of the US government at this time. And now I wanted to share a video with you of our new Prime Minister, Mark Carney, who had campaigned on eliminating the carbon tax at the consumer level. But please make no mistake that carbon pricing and carbon tax is just moved over at the industry level. So it won't be felt on the street level, right, when you pay at the pump or when you're buying goods, but it will be felt at the industry level. And of course, that's completely opposite to the US policy. Not sure how you feel about either, but just when you think about the concept of trying to reduce expenses for our domestic industry so that they can, not just so that they can thrive, but just survive, right? Because every business needs to be profitable in order to stay in business and keep all of its employees employed, and us as a country benefit from all of the spin-off economic benefit that each business brings to the table in Canada. So as we all know, if a tax is put into place, it is an extra cost. That cost is now not being seen directly at the street level, but it's on the industry level, which means their businesses' costs are going up, and then they either have to, in order to maintain profitability, either have to reduce their own expenses, either by eliminating jobs or by increasing their revenues to cover that cost so they can stay in profit. Yes, some of these businesses have huge profit margins at points in times, but they're very cyclical. Sometimes the profit margins are razor thin, almost none. Sometimes they do very well. And it's part of a good business to be able to manage those cash flows, save up money for when times are bad, to get through those bumps, and do well when times are good so that they can stash that money and get through peaks and valleys, which happen in every single cycle. So Just want to share this video with you just so you can see for yourselves.
Guess what one of the requirements is to diversify trade to the European Union? Guess what one of the requirements is to diversify trade to the United Kingdom? Guess what one of the requirements will be to diversify trade to emerging Asia? Is to have a form of price on carbon. So we are able to think one step ahead. We're able to go out and see the world. We're able to help Canadian companies prepare. And you know what's going to happen 5 years, 10 years from now? If I have the pleasure of being in front of you, you'll be asking me the question, if we didn't do this, if we didn't help our companies get more prepared, the Americans are going to start caring about this again. They have elections every 4 years. They cared a great deal about this 3 months ago. Now all of a sudden they don't care about it. They're going to care about it again. We have an enormous opportunity here in Canada. The United Kingdom has an enormous opportunity. France has an enormous opportunity. Europe has an enormous opportunity to leapfrog over American companies where they're trying to turn back the clock and look inwards. We're going to take that opportunity.
So there you have it. Our current administration believes that having a tax on carbon, which will rise or increase the expenses on our industry, is going to make our industry more competitive around the world. So the question would be then, will new trading partners like the European Union not do business with Canada if we don't have a tax on carbon? Well, currently the European Union imports oil. Their major suppliers are from the Middle East, which includes Saudi Arabia, Iraq, the UAE, and Kuwait. This is where they get the majority of their oil from, followed by, they've diversified into Norway, US, Russia before the sanctions, and North Africa. So when we think about Canada as a global energy leader, our environmental standards and policies, our technologies for carbon capture, etc., it feels like there's an opportunity for us to strengthen trading relationships around the world. And there are several other countries that would love to do business with us, including Asia, the Asian markets. They have a huge demand. India, large growing populations that need access to energy such as oil and cleaner energy such as LNG, which we have a lot of. My understanding is that the countries that do have a tax on carbon would include Norway, has one of the highest carbon taxes, the United Kingdom, and Canada, which needs to be verified, is currently $80 a ton in 2024 and is scheduled to rise to $170 per ton in 2030. In the United States, only California and Washington have a cap and trade system, and some other countries have some, such as Denmark and Netherlands, have a carbon tax. However, the countries without a carbon tax include Saudi Arabia, Iraq, United Arab Emirates, Kuwait, and Qatar, which tend to be the larger suppliers of oil to the European Union. So it's quite possible that during this precarious period of time over the next 5 to 10 years, while we need to build up the infrastructure so that we could actually get our products to other trading partners around the world, this will be a 5 to 10 year plan, make no mistake. We could take the pedal off on the carbon tax, be more competitive, and compete with other exporters like the US and secure those relationships. And we can revisit this at another time. At a time when we're in a very precarious state and we need to do everything that we can to generate economic activity domestically by, getting rid of our trade barriers amongst our provinces and getting all of our products to other countries around the world, it would seem to me that there could be better choices in terms of policies. But I leave that up to you, and you get to make that vote when you have the ability to do that, and that right is given back to you after our government is no longer prorogued and the Liberals had their opportunity to install their new Liberal Prime Minister, and we, the people, have the opportunity to vote for the government that we want to lead us through this next period of time. So please keep all of this information in mind when you have the opportunity to vote. If you've ever wanted to understand who's to blame for our housing unaffordability, I highly encourage you to take the time to watch this video from our local developer CEOs, the top pre-sale marketing company, Bob Rennie, the founder and CEO of Rennie Marketing Systems, and one of our local mayors. Our provincial government has implemented new zoning policies that we can bring that multiplex zoning and transit-oriented development, basically pre-zoning areas to bring more housing density to the people in an effort to create more middle housing. But we still wonder, how's that panning out? Is it really helping the industry? And really, who's to blame for the crazy costs of housing? I encourage you to listen to this if you ever wondered what it takes to bring one home to market and truly understand the landscape these developers must navigate to be successful. I think it's truly eye-opening and everybody should be informed of this information. I encourage you to watch the video in the link below because this will give you an idea of the storm or the weather we're going to be facing over the next couple of years as we get through this economic cycle that was already in existence before the tariffs even came to the table, which will just make housing more expensive because all of those components or many of the components will face tariffs. The housing market just cannot get a break. And perhaps that will just make this period of time drag on and bring more affordability through the demand and supply cycle, where we're starting to see more supply, starting to put downward pressure on prices, as well as economic factors such as higher interest rates, higher costs, not just construction, but insurance, and lower revenues through rents. I hope you enjoy. I'm Christine Kopr. If you enjoyed this segment, make sure you like and subscribe to my Instagram, my YouTube, and sign up for my monthly newsletter so that you get this market report in your inbox each month. And of course, if you have any questions or things that you want us to touch on next month, I welcome the opportunity to hear what those ideas are. And with that, I wish you all the best for the month of March. See you next month.